It's time for the Personal Finance Corner. Faye is here to walk us through what's lined up for discussion today. Faye?
Well, today we're talking about the fact that debt funds might look a lot like a fixed deposit, but there's a lot of risk in a debt fund that a fixed deposit might not have. Let's bring in Dhirendra Kumar, the CEO of Value Research. And Dhirendra, we were talking about this last week off the show with the fact that debt funds sound very similar to a fixed deposit, but it's important for investors to understand there's a risk that comes with debt funds, especially with the kind of dependency we have on FII money right now. Can you explain to our investors what we should keep in mind when we are investing in debt funds?
One most important thing which investors should remember all the time, that debt funds are relatively safe. They are much more far more safer than an equity fund, but they are not risk-free. Because most investors do the mistake of comparing a debt fund and with a fixed deposit, that the worst case scenario is that your money will never go down. That is not true. A large, there are a variety of funds, there are a variety of debt funds. Maybe liquid funds will generally don't go down in value, but there has been one occasion when they also did go down on a one-day basis. That apart, there are debt funds which could be very risky. As I said earlier, that they are not as risky as an equity fund, but they can go down in value by 3, 4, 5% in a month's time, or if they are faced with a very adverse rate outlook situation, which changes dramatically in a brief period of time. So I think the way to, and there are ways to mitigate the risk of debt fund, which is when you are investing in a debt fund, it is very important that you define your investment time frame. Whether you are parking your money for 3 months, 6 months, 3 days, 5 days, or 2 years. And from that standpoint, if you choose the appropriate fund, you are unlikely to be disappointed. The real problem is that when investors have very short-term money, which is invested in a fund, which gets invested in a fund, which should ideally be held for a longer period of time, and in a short period of time they can turn very volatile. That is and in many situations investors take those risks, and I would say that is inappropriate, more so now, because from here on I feel that with FIIs beginning to having invested in debt funds and now beginning to move their money out as well on occasion, the debt fund in India has become very turbulent, and this volatility investors have not been used to. This is a big change, so don't get into a mismatched product. Don't put your short-term money into long-term debt funds.
Dhirendra, we have a question from one of our viewers today. C. Ramachandran has written in. Now, he can set aside about 10,000 rupees every week for mutual funds, he says. He has 9 years of work left before he retires. And he tells us he has enough insurance. He also has a pension plan. What he wants to do now is beat inflation before he hits the age of 70. Now, that's a fairly good goal given where inflation is right now. So if he wants to beat inflation on his pension plan, investing that much money every week in mutual funds, where would you like him to put that money?
You are a very well planned investor, so if you are planning to accumulate your savings, I would say that a safe and a very tax efficient way of achieving your goal, investing 10,000 rupees a week, you can accumulate substantial wealth in this time frame, and a reasonably safe way of or a stable way of doing this will be investing in a balanced fund. I would say choose 2 balanced funds from our stable growth portfolio. Invest 10,000 rupees a week, and this will prove to be, this will be very tax efficient, because these balanced funds, they invest 70% of the money into equity, 30% into debt. All the gains from this fund, if held for over 1 year, is tax free. So even your 30% allocation to fixed income achieved in targeted to invested in debt is also converted into a capital gains, tax free equity gains. So this is the best possible way, I think, a very efficient vehicle for you to accumulate your savings, and in a reasonably stable way.